In this video, traders, we look at how important are earnings when you're trading a stock, or how important is Fed, how important is non-farm payrolls. Let's look a little bit closer. Stay tuned. Hey guys, very warm welcome to you. Thank you for joining me. All right, so how important are earnings when you're trading a stock? How important is NFP? How important are jobs numbers? How important are all these kind of unique announcements that affect the underlying market you're trading? So the main thing that we've got to be concerned about, which isn't kind of the focus of the video, but something that has to be said, is that these can create volatility. So of course, if you're in a trade, you need to be aware they're coming up. If NFP is coming up, non-farm payrolls are coming up, and you're in a trade, you might not want to be in that index, you might not want to be in the dollar, you might not want to be in gold, because you may find that sometimes if it's way out of line, the market's going to move excessively one direction or another, and you might end up getting caught in a position you don't want, or caught in a move you don't want. Your stock might not be filled at the right price, all that kind of stuff. Probably don't need to cover that. But one of the important things, guys, that I think is overlooked about earnings and about all these kind of things is, and now obviously earnings, it can be slightly different because a company has really good earnings, it just revalues the company, and I call it repricing the market. And it's similar in a way to some of these other things like NFP jobs. And obviously, if you're looking at Fed, you're looking at Bank of Japan, Bank of England, all the other central banks, that's going to affect probably the currency more than the equity market, because there's a direct impact on that. If interest rates have suddenly gone up, if interest rates suddenly gone down, you get the idea. So it might affect the currency pair that you're trading. Earnings are going to affect the individual stock, and then FP jobs as well could affect the equity markets. An index could also affect the forex pair you're trading as well. Anyway, the point is, guys, is you could get a reprice on this, but even if you don't, assume that they don't get a reprice. In other words, a revaluation. Super good earnings, companies revaluated 10% higher. Super surprising interest rate cut, market moves aggressively one direction or another. The thing is why it is so important is that you have a line in the sand that everybody is now looking at, and this is so useful when you're trading. If you have a reference point to look at and see how price responds to it, you'll know that I talk so much about how price responds to a level that everyone is looking at. How is it responding to the high? Is it ripping through? Is it faking? Is it holding? This is something that is so key to giving you an idea for your next trade and understanding how the market is feeling about certain things. This is another line in the sand. So let's say earnings have come out here. Again, substitute earnings for NFP, substitute it for Fed, whatever you're trading, but earnings is a good example with stock. Now you see price constantly trade lower after earnings, even if it's not going aggressively lower. What can you deduce from that? You can deduce that the supply demand is now very much in favor of more demand coming in after the earnings. Now, is it a coincidence? Is it a catalyst? You don't know for sure. We don't know for sure, but you could theorize that, hey, especially if you've got something as obvious as this, these earnings aren't that good. People have obviously taken profits into these earnings, especially if you've got an uptrend beforehand. And again, this could be different. This could be range bound. This could be anything. But you're kind of saying, okay, this is where we have everybody looking at. Everybody has seen this, and so as a trader you can say, well, you know what, maybe this now becomes a level I need to look at. Maybe if we get back to this level, I can start to sell it, because actually a lot of people have been selling it and thinking that that's bearish, and now we're going to see exactly how price responds to that. It's the same if we've got really good number from Fed, whatever the number may be. And I understand, guys, that sometimes things that appear bullish are bearish or whatever, but the point is, if we get a reaction one way or another, everyone's looking at that. Everyone's saying, hey, where's the price competitive? And it's always worth marking on your chart a key news item. Exactly a horizontal line. That was when earning close was at earnings. That was the close, or the time that the Fed came out, or BOJ came out, whatever it was, NFP came out, and then seeing how prices responded. If price is persistently above that, you can see, well, hey, when we pull back towards it, it might be considered a good buying opportunity, because everyone has thought this is a really good buying opportunity anyway, because we've fundamentally revalued the market we're trading, fundamentally revalued the currency pair, fundamentally revalued the company. If things are different and people are perceiving it as that as well, And so, it's important and use it as an anchor point. I like to use this kind of reference as an anchor. So, hey, that was the earnings. This is how prices responded to earnings. Wow, it gapped up on earnings. It's flagging at highs. Even if it's pulling back over time, we still know that that earnings point is probably a good line in the sand because people are still valuing it higher. So anywhere if price gets near to it, then wow, it's a bargain because the people have perceived earnings as more valuable for the company. So as price gets closer, the more of a bargain you get, the more likely bulls are going to push in much sooner. It's why we get high tight flags, why we get shallow pullbacks, etc. So even if you don't get an extreme move, even if you don't get that reprice scenario, even if you don't get the volatility spike that sometimes comes with these things, the fact that it's there, the fact that everyone is using that as a benchmark themselves, the fact that everyone is kind of saying, hey, and often as well, guys, people look at markets in terms of quarters, in kind of time cycles, so the quarter, the year, half of the year, whatever it may be, the month. But also look to in terms of announcement cycles. So earnings, how did it perform between these two earnings? How did it perform through these two earnings? How did the currency perform between these two Fed announcements? How did the equity market between these two job announcements? So that also is how often bigger players slice things up. So it makes sense yourself to align with these type of things. Take care, guys, and I'll see you in the next one. Keep your risk managed. Bye-bye for now.